$925,000.
Cash collected from customers,
Okay.
925.
What did you get for cash paid to suppliers, Ms. Jones? 608,000 is correct. What did you get for cash paid for operating expenses, Ms. Toomey? 226,000 is correct. Mr. Jackson, what did you get for cash paid for interest expense?
I did not get.
You did not get any for interest expense.
No, I didn't get.
You didn't do it. Okay. What about you, Ms. Jernigan? Interest expense.
I didn't get any.
There's none. So, Ms. Jernigan, what did you get for cash paid for income taxes?
43,000.
43,000 is correct. So when you combine the 925, the 608, the 226, and the 43, you should get net cash provided by operating activities, 48,000. How are we doing, Ms. Jones? Okay? So then, let's turn to the indirect method. Part B. You start with net income. How much was net income? 67,000. Good. Then we're going to adjust for non-cash income and expenses. What do you have? Depreciation expense. How much? 22,000. Good. Then we're going to adjust for gains and losses on asset sales. What do we have? Do we have any of them? Gain on sale of what? See, if you abbreviate so much, you can't even tell what you wrote. Investments. How much is that gain? 15,000. And what should we do? Subtract it. Then what else do we have? Or do we have any more? Loss on sale of equipment. How much was that? 3,000. Add it or subtract it? Add it. Okay, what is the third type of adjustment that we do, Mr. Carr?
The third type of adjustment is the change in the current assets.
Change in current assets. Okay, so let's go to the balance sheet and we're going to skip over cash. What is the first current asset after cash? Huh? Accounts receivable, thank you. Change in accounts receivable dash net. So you got to do accounts receivable net. All right. So what is the change in accounts receivable net from year 16 to year 17? Huh?
$23,000.
$23,000. 23,000. And do you add it or subtract it? Subtract it because it's an increase. Okay, what's the next current asset? Inventory. Okay. Change in inventory. 14,000. Did it go up or down? Up. Inventory going up. Asset going up. Is cash going down? So that's a negative number. What's the next current asset? That's it. You need to say the next one is available for sale securities, which are non-current, therefore I quit. I don't do any more current assets. So now you gotta go to current liabilities. All right? I see allowance for doubtful accounts, but that's not a current liability. I see accumulated depreciation for two things, but that's not a current liability. Accounts payable. There's my first current liability. Change in accounts payable is $6,000. It went from $60,000 to $66,000, so that's going up. A liability going up is cash going up, so that's positive. Is there another current liability? Income taxes payable, so change in income taxes payable went from $10,000 to $12,000. My math tells me that's $2,000. That's a liability going up. Yep, Ms. Toomey needs to add that, or need to subtract that. Give her a second.
You're right.
2,000, okay. That's an increase, so that means cash did what? Went up, so that's positive. Okay, what's the next current liability?
That's it.
Long-term notes payable tells you that's non-current liability, so we stop. So now you need to combine your 7 adjustments, and what do you get? A negative 19,000. Negative 19,000. So then 67,000 minus 19,000 should give me 48,000. Net cash provided by operating activities, which is the same answer we got on the direct method. So we're feeling good about our answer. Okay, let me give you a couple of check figures for cash flows from investing activities. The answer is 14,000 positive. And for cash flows from financing activities, the answer is 43,000 negative. So when you take 48,000, add 14,000, and subtract 43,000, the change in cash during the year was 19,000. And the cash at the beginning of the year was 51,000. So 51 and 19, cash at the end of the year should be 70,000. Questions? How do you feel about the statement of cash flows now? Feel better? The way you learn, because this is totally new to you. I mean, this is brand new. You did them in 212, but it's a totally new thing. You've been doing journal entries in most of the other chapters. Now all of a sudden, or calculating earnings per share. Now all of a sudden you got a big old financial statement that can go on for pages. So it's a lot more work. And it's a lot of moving parts. I mean, we had to deal with every account on this balance sheet and most of the items on the income statement. That's a lot of stuff to keep up with. But that's why you do them over and over and over again until it becomes second nature that you're doing it. So, I have some additional work for you. I want you to do this and complete it for our review this weekend.
Wait, so what day's the review?
Well, we gotta decide.
Okay, I thought I missed something.
By the way, in number 1, net income for the year was 71,000, 4,000? There's one too many zeros in 400. All right, so I'd like those of you who are going to be able to be in attendance at the review, which I'm assuming we're going to have on Sunday afternoon.
No, please not Sunday. Sundays are hard for me.
I feel like it should be earlier.
Yeah, if we can do it
Like-
during the day.
No, like a different day. Like I feel like it should be Friday or Saturday.
Friday or Saturday.
And it gives us more time to study.
Okay? So what do you say? You nominate a time, somebody.
Saturday at 9.
Do we want to do we first let's deal with Friday. Friday?
I like Friday. I like Friday.
I like Friday at like 2.
I got
Like between lunch and dinner time, like Friday at 2 sounds cool to me.
That sounds good with me.
Friday at 2. Any more Fridays? Okay. Saturday at when? 11. Any more Saturday?
For me, it's any time Saturday. So I guess like Saturday at 2.
Saturday afternoon? Give me a time.
Is that 2?
Oh, at 2 instead of afternoon. He said 2. Okay, any more?
Not Sunday.
You can't vote for not Sunday. You can vote for any of those, but you can't vote for not Sunday. Okay? Sunday. Notwithstanding him. Sunday's doesn't do it for us. Okay. All right, so let's vote. And remember, whatever one wins, wins. You can vote as many times as you want to. So, how many vote for Friday at 2 p.m.? 1, 2, 3, 4, 5, 6, 7. No, I've already.
Hey,
passed.
Mr. Rowland, it's 8. It's 8.
I won't be there.
Saturday at 11. 1, 2, 3, 4, 5, 6, 7.
Mr. Rowland, vote for Friday. I promise you.
Just saying.
Saturday at 2. 1, 2, 3, 4.
We could get 3 more people.
Okay, we're gonna have one more vote off between these two, and we're gonna reverse the order this time. Saturday at 11. 1, 2, 3, 4, 5, 6, 7. Friday at 2. 1, 2, 3, 4, 5, 6, 7.
Someone dropped.
What about you? I mean, you pick, I guess.
Eeny, meeny, miny, mo.
Can we nominate each
Flip a
other?
coin.
Like Friday at 6.
What?
She said, whoa, that didn't go over very well, did it?
I mean, I still have nothing going on at that point.
When do you get off work? I get work off at work. I get off work at 5.
You got a coin?
Man, Saturday at 9 is not
You can
bad.
put my eraser.
No, give me a coin. Got a dime, nickel,
What's
penny?
that look for, man?
Any coin? You got a coin?
My goodness, this is a fine.
Nobody carries money around here?
Can we nominate 2 more times?
No, we're gonna flip it one time.
Oh, Lord, have mercy.
Oh, gosh.
Let's do that.
All right. Okay, who is a strong advocate for Friday at 2? All right, Miss Toomey. Who is a strong advocate for Saturday at 11? Okay, Mr. Evers. Okay, so Miss Toomey.
Tails never fail.
Heads is going to be Friday at 2.
Oh my goodness. Just that tails never fails.
So are you going to call it while it's in the air?
Alright, oh wait,
And it's going to drop.
wait.
It's heads or tails. That's all you got to do.
So wait, I'm asking you, did you say heads was Friday?
Yeah, but you're just trying to guess. Oh, well, then I guess it matters.
We're throwing two variables.
All right, so heads is going to be Friday. Tails is going to be Saturday. Huh?
Yeah, no. I'm tails, he's heads. Whichever one it goes on. You never watch football game. Whichever one goes on, they're like, okay, it's going
No, I already decided. Heads is the first one, tails is the second one, so here we go. Heads.
So Friday.
I'm gonna write this.
Difference. Okay. Who knows for a fact they will not be able to be here on Friday at 2? Okay. What I just gave you is the indirect method solution with some of my T account scribbling. No, I'm not gonna do it. But what I'd like you to do is try to do it on your own and then see what you're having issues with. I mean, go back and see if you can figure out what you did wrong. But for those of you who are going to be at the review tomorrow afternoon, please bring your problem and the solution with you, and we'll go over it, and I will give you my solution then. Okay? Questions?
Are we about to do chapter 22 now?
Do you want to be in charge? We never had a student say, could we move this along?
Back on track.
Chapter 22, if it pleases the court.
Yeah.
Accounting for errors and changes. Okay? Now I don't want you even bothering to look at your notes. I just want you to listen to me. And then we're going to go to the notes and focus heavily on the notes. All right? What are comparative financial statements? Huh?
2 years.
2 years, right? I mean, we just finished looking at comparative balance sheets. That meant 2-year end balance sheets back to back, right there for you to look at, okay? So think of that in your mind. If a company presents comparative financial statements, that would mean December 31, 2018's balance sheet right alongside December 31, 2017's balance sheet. And your income statement for the year ended December 31, 2018, and right next to it is for the year ended December 31, 2017. All right? Errors. If you discover in 18 that you made an error in your financial statements in 17, and you are issuing comparative financial statements at the end of 18, then you got to go back and fix the error that existed in 2017. restate those financial statements for 2017 to fix them. Are you with me? And then report 2018 the way it ought to be. Okay, wait a minute. Suppose you made a mistake you just discovered, but you made the mistake in 2016. And we're not restating 2016 because we're not even presenting it. We're presenting 17 and 18. Okay? If it is an income statement mistake, you go in and adjust the opening balance for retained earnings for the earliest year presented, which would be January 1, 2017. Right? That's the earliest retained earnings amount. And you would adjust it to what it should have been if you had gotten 16 right in the first place. Then you just go on forward. You with me? I mean, we're not restating 16 because we're not even issuing those financial statements. Okay? So, if we're issuing comparative financial statements and the error occurred in a year that we're issuing, restate the financial statements the way they should have been correctly presented the first time. Okay? If the error affected years prior to the earliest year you're presenting, make an adjustment to the beginning balance of retained earnings for the earliest year presented. Are you with me? Okay, that's easy.
Is that it?
Errors is restate. Don't reissue those financial statements with what you know are wrong numbers. Go back and restate the financial statements, fix them. And you say, okay, the error happened in 2012, and we're only issuing 17 and 18. Then you go back and make an adjustment to the beginning balance and retained earnings for the earliest year 2017 presented. Okay? That's really easy correction of an error. Now, changes. There are multiple types of changes. The first one is the general rule for a change in accounting principle. Change in accounting principle. Okay, now what is an accounting principle? Give me an example.
Inventory methods.
There you go. We go from the specific identification method of determining the value of ending inventory to the FIFO method. Okay? That's an example. Remember the classes you had called Principles of Accounting? And that's where you learned that, the inventory methods, all that kind of stuff. So if you change, now listen to me, if you change from one good GAAP, one thing that's generally accepted, to another thing that is generally accepted, that is a change in accounting principle. If you go from cash accounting to accrual accounting, is cash accounting generally accepted? No. So that's the correction of an error. So we'd have to go back and restate, right? Listen, I said if you go from one good GAAP to another good GAAP, something that is accepted to something else that's accepted, okay? Here's what you do. If it affects prior years, you don't have to write this down. I'm going to go over the notes in a minute. I want you listening. If it affects prior years, restate them on the new accounting principle. You can't reissue financial statements that some are on one principle and some are on another. No, it's not going to be comparable. So the user of the financial statements is going to be confused, so we don't do that. Restate the financial statements of the prior period as if you had been on the new principle from the get-go. Okay, but now think about it. What if the change in accounting principle affects years prior to the earliest year you're presenting? You make an adjustment to the opening balance of retained earnings for the earliest year presented. And if you change from one inventory method to another inventory method, that's going to affect all the years that you had inventory, isn't it? So it's going to affect 17 and 18, but it's also going to affect 16, 15, 14, 13 too. So it's going to affect. How are we doing? That makes sense? Okay.
Yeah, I just skipped through 2.
Then there's an exception to the general rule, and that is 2 LIFO. The 2 LIFO exception. In this case, you probably don't remember this, but in 371, you probably discussed LIFO layers of inventory. Okay? And the way you get LIFO layers is like last in, first out. Okay? So the last ones we bought are considered to be the first ones that are sold. So let's say that we bought these at 5, we bought these at 4, these at 3, and these at 2. Okay? So if and I didn't put how many because it's immaterial. Once I sell these at $5 a piece, I start taking these out at $4 a piece, right? And so on and so forth. But if, for example, you had been on FIFO, FIFO says first ones in are the first ones out. So you might not have kept your records in such a way that allow you to go back and create what your LIFO inventory layers would look like. What the accounting profession says, it might be impracticable. I say impossible to do. And in that case, you can't go back and restate. If it's impossible for you to go back and recreate your financial data in such a way that you could have been on LIFO, then you say, I can't do it. I can't look back. I can't go back and change anything. Instead, what I'm going to do is I'm going to be on LIFO on January 1 of 18. I'm going to use that beginning balance of inventory for my LIFO starting point. And I'm not going to go back and restate anything in the past because I can't. And I'm going to explain to the reader, I'm not able to go back and restate. So I'm sorry, the 17 and 18 numbers are not going to be entirely comparable because I was on one inventory method in that year and one inventory method in this year. But this is the only year that's going to be a problem because next year, I'll still be on LIFO, so we'll have 19 and 18 both on LIFO. And the only reason I don't restate is because it's impossible for me to do it. If that is the case. Now, it could be you kept your records in such a way that you could go back and recreate them. But the 2 LIFO exception says if it is impracticable to do so, then don't even try. Okay? Then, the last type of change is reporting entity. And here's what we're talking about. I heard, let's see, who was it? Has anybody else heard the Southern Company plans to sell Gulf Power? Y'all hadn't heard that? Do they plan to sell anybody? Have you heard that? Okay, then I'm right. They're selling Gulf Power. I don't know if you know, the Southern Company owns Gulf Power, Alabama Power, Mississippi Power, Georgia Power, among others. Let's just act like that's all. Okay? So every year they provide financial statements. Their consolidated financial statements will include all four of those subsidiaries' results. Okay. But I'm pretty darn sure, unless I was smoking dope, that Gulf Power, Southern Company has just announced they intend to sell Gulf Power. Okay, now think about that. Let's say they're able to get it done by the end of 18. It'd probably be hard to do, but let's just act like they are able to. Well, then when they issue say they sell them, tomorrow. So at the end of the year, they don't own Gulf Power anymore. If they issue financial statements that include Gulf Power for this year, then that's including an entity we no longer own. So what you would do is you would drop Gulf Power out of 2018, and you would drop Gulf Power out of 2017, 2016, 2015. Because you're wanting to provide financial statements that are going to be comparable to financial analysts and only include the same companies for all the years that you're presenting for. That makes sense? So think about it. In 19, should they include Gulf Power back in 17 and 18? No, because they dropped them in 18, so in 19, 18, 17, drop. You want the same reporting entities in your financial statements for each period so that they are more comparable to each other, more comparative, as opposed to representing 15 companies versus 2 now. You see all these big, you say, well, total assets just dropped dramatically. Well, yeah, you went from 16 companies to 2 companies. Yeah, I would expect total assets. So it shouldn't have happened. You ought to have 2 companies last year and 2 companies now. You with me? That's restated. Okay? Then, the last thing is accounting for an estimate. And we talked about this. We talked about this in the income tax chapter. There are lots of estimates in accounting. Some of those would include warranty expense, depreciation expense, bad debt expense, all right? The income tax rate that's going to be in effect when a temporary item reverses. Remember, we said you do that based on the enacted tax rate is 40%, and then all of a sudden after you've recorded that, boom, they change the tax rate to 30%. Well, that's a change in an estimate. Okay? So there are lots of estimates in accounting. The question is, what do you do when you decide that an estimate that you have based financial statements in the past on, that estimate is no longer the best? Now you've decided that instead of 2% of sales, you think bad debt should only be 1.5% of sales because the economy is so much better. So many companies are doing so much better. So companies are not declaring bankruptcy and telling you they can't pay as much as they did in the past. So even though you've used 2% for the last 2 or 3 years, if you decide to change your estimate, you change it as of January 1, the first day of the current fiscal year. You change it to the new amount, 1.5%, and you do it now and going forward, you do not look back. You do not go back and change the past. Now and forward, currently and prospectively. How we doing? Look at page 2 of your class notes from chapter 22. What I did was basically take an illustration toward the end of the chapter and I expanded on it. And blew it up because I said, this will be the perfect way to lecture on this chapter from this one single page. So, summary of accounting changes and corrections of errors. Roman 1, change in accounting principle, the general rule. 1, or A, employ the new accounting principle as of the first day of the fiscal year in the year of the change. So if you make the change in 2018, you have to make it on January 1 of 2018. If you say, well, no, I can't go back and do it as of January 1, then hold off and do it January 1 of 19. You don't have a choice. Got to do it as of the first day of the year. B, restate the financial statements of all prior periods presented. C, disclose in the year of the change the effect on net income and earnings per share for all prior years presented. Say, if we had been on this new principle, then net income back then would have been X and earnings per share would have been Y. And do it for all years presented, prior years presented. Then part D says, what about the years that happened before you ever got to the earliest year you're presenting? Report an adjustment to the beginning balance of retained earnings in the retained earnings statement in the earliest year presented if the new principle affects years prior to those presented. How are we doing? Okay, Roman 2, change in accounting principle when it is impracticable to do so, to restate, i.e. a change to LIFO. A says, do not change prior year's financial statements. B, use the opening balance for inventory in the year the method is adopted as the base year inventory for all subsequent LIFO computations. C, disclose the effect of the change on the current year and the reasons for omitting the computation of the cumulative effect and pro forma amounts for prior years. Why are you omitting the computation of the cumulative effect and pro forma amounts for prior years?
Because it's impossible to.
Because it's impossible to do it.
Yeah.
That's exactly right. Okay, Roman 3 says, change in accounting estimates. Employ the current and prospective approach by A, report current and future financial statements on the new basis. B, present prior period financial statements as previously reported. C, make no adjustments to current period opening balances for the effects on prior periods, because we do not go back and restate. Roman 4, changes due to an error. Employ the restatement approach. A, correct all prior period statements presented. And B, restate the beginning balance of retained earnings for the first period presented when the error effects occur in a period prior to the first year presented. and then Roman 5, changes in reporting entity. Employ the retrospective approach by restate the financial statements of all prior years presented. And B says disclose in the year of change the effect on net income and earnings per share for all prior periods presented. Okay, now I want you to look at in the first one, Roman 1, it had an asterisk by change in accounting principle. Okay? I want you to look on page 3 where I have the asterisk and the explanation. Changes in accounting principle are appropriate only when the company demonstrates that the newly adopted principle is preferable to the existing one. Companies and accountants determine preferability on the basis of whether the new principle constitutes an improvement in financial reporting, not on the basis of whether it makes us look better or worse. For example, you know there's a big difference between LIFO and FIFO, right? But some companies are on FIFO and some companies are on LIFO. So how can some companies be justified in being on FIFO and other companies be justified by being on LIFO when they're so different?
Because they both have this, like, the same purpose. I mean, it's both related to inventory turnover. And, like, in suppliers.
Do you say something?
I said it depends on the product.
Depends on the product. If I told you,
Go ahead. Never mind.
you're giving me permission to continue too. Is there something about this aisle of people? Okay. If I told you that the people who think LIFO, they want to be on LIFO. If they say because we think the balance sheet is superior to the income statement, would that explanation make sense to you? I want you to think about that. For somebody who's on LIFO, they say the reason we're on LIFO is we think the balance sheet is superior to the income statement. Now I want you to mentally think that through. Was trash. Does that explanation ring true to you as an accounting major?
No.
No, you say. Nobody else said anything. They looking down saying, don't call on me. Why does it not make sense to you?
I mean, like, well, first of all, how can you separate these, like, just compare these two without even taking the cash flow statement into account? Like, how can
Okay,
that be a
but we
reason
can. So let's.
Okay.
The people who justify being on FIFO and being on LIFO do so by saying, we think the income statement is superior to the balance sheet, or we think the balance sheet is superior to the income statement.
No.
So I want you to tell me which. So you got two choices. We're on FIFO. Balance sheet superior to income statement, or income statement superior to balance sheet and LIFO. So I need to know, does it go, yes, that's it? Or is it, no, that one goes with that, and that one goes with this?
Well, so what's the argument behind using LIFO, right? So over the long term, LIFO.
Okay, that's exactly what we're getting
In
to.
concept, LIFO, over the long term, your pricing is gonna be lower, assuming
Your,
that you.
your pricing, what do you mean?
So if I'm using last in, first out, my pricing, I'll be using all of my high priced inventory. So my inventory, overall pricing or value will be lower over the long term.
Okay, so
because
listen to
my pricing is gonna
that. So what did he
continue to
just
rise.
say? If I'm on LIFO, in a period of rising prices, over time, my inventory is going to be stated at the old cost. So there's gonna be a big gap between what's on my balance sheet and what the real current value of it is. Okay? So the people who say that say we're on LIFO because the income statement is superior and we have current cost going to cost of goods sold to be matched with current revenues. Therefore, they think the income statement is superior to the balance sheet.
So does the question
So
of
it is
inventory
this.
turnover come into play in any of that? Because.
No. Because it doesn't matter about the turnover.
What about perishable goods?
Well,
It doesn't matter. It does not matter what actual goods you're accounting for. I mean, because remember, these are assumptions.
yes, a theory, right?
It's your inventory flow assumption. Because let me ask you this. If we're a store and we're selling these, okay? And let's say they come down a thing, you know, but she bought this in a convenience store, and when she took this one, then the next one slid down. Okay? All right? And so she comes in and she's like, you know, I'm an accounting major, I'm a little weird. I want a really cold one. So she reaches back in there and she wants to get one back in the back. And somebody slaps her hand. You can't do that, we're on first in, first out. There is no requirement that the assumption, the first in, first out, last in, first out, average cost, specific identification, has to match the physical flow of the goods. Because if somebody's not back there to slap her hand, how can anybody tell whether this is the first one in or the last one in? We can't. The only thing we can tell is that describes it. That describes it as a 1 quart, 1.8 fluid ounce, or a 1 liter Glacier Smart Water. That's all that UPC code tells them. It doesn't tell them what they paid for it, because that's going to be the same code over the next 10 years when the price changes all those times. So all that does is identify the product. That's why it's called Uniform Product Code. Okay? So there's no requirement that the actual flow of goods out of our store has to match the assumption that we use, because in most businesses it's impossible to determine what the actual flow is because we sell identical stuff. And it's impossible to know. I mean, go to the grocery store, a can of Crisco, can of pork and beans. You can't know what was paid for them because every can of the pork and beans look alike. Now, if I'm selling diamond rings or, jewelry, that everything is separate, that's identifiable, separate from each other. Now I can figure out what the actual cost of goods sold, but there's no requirement in accounting that I use that method. I can use any method I want to. Okay? So here's the deal. If I'm on LIFO, it is because I think LIFO provides a better matching of current expenses against current revenues, and I think the income statement is superior to the balance sheet. I know my balance sheet over time is going to be further and further off, but I don't care because I think the income statement is more important. You with me? Whereas if I'm on FIFO, I say, no, I want that balance sheet inventory account to be pretty darn accurate. I want it to be pretty darn close to what the actual number should be. And I don't care as much about the income statement. So see, I didn't even know that I was writing right across from them the answers. I just knew that I could figure it out by talking through it. But some companies say, I think the income statement is superior, so we're on LIFO. Other companies, so somebody says, we're on FIFO because we think the income statement is superior, they're stupid. That is not an explanation that makes any sense. It doesn't, you should be able to think that through, and you should have done this in 371. You should have talked about the balance sheet superiority or income statement superiority.
So on public companies, when they release a 10K, would they disclose their inventory method somewhere in there?
Yeah, where?
I guess on the balance sheet,
You say on the balance sheet, probably not.
income statement.
Footnote?
Income statement, no.
Footnote?
Notes to the financial statements. And now they could, and this is something you should have talked about in 371 too, they could say inventory parentheses at FIFO cost. They could. Nobody does that. Instead, they wait, and in the notes, there's a paragraph about inventory. And if you have multiple things, like new cars versus used cars versus parts, a car dealership, they can say, we're on specific identification for new cars, we're on first in, first out for used cars, and we're on average cost for parts.
Okay.
So they have to tell you what inventory flow assumption they have made with respect to every different category of their inventory. Or they can say, we assume first in, first out for all inventory items. Well, there you know, everything they do it on FIFO. If you ask me, think about this, a car dealership ought to be on specific identification. Why?
VIN number?
Huh?
Yeah,
They have a VIN number. We know exactly what that car cost us, and we know exactly what we just sold it for. So we can put the actual right number for sales and the actual right number for cost of goods sold. But there's no requirement. Most auto dealerships are going to be on LIFO. Why?
Because their older inventory starts to decrease in value as
He said because their older inventory starts to decrease in value. So now our cost flow assumption has to match what happens to the value of our inventory? No. Think. Okay, what happens to an automobile dealership every single year late in the year?
get a bunch of trade-ins.
New models. Okay, think about that. New models come out. September, October, November. Are they more expensive or are they all cheaper? They're more expensive. So think, I'm an auto dealership. I know that later in the year, the cost of my inventory is going up. Okay? So I'm on LIFO. So that I can use the higher cost of that inventory against the sales of current inventory so that I reduce my profits, reduce my tax liability, and postpone having to pay income taxes. Because there's something called the LIFO conformity rule that happened in 1987. It used to be that companies could be on FIFO for financial statement purposes and could be on LIFO for tax purposes. Now, no. There's the LIFO conformity rule. If you use LIFO for tax purposes, you have to be on LIFO for financial statement reporting. And remember, we're on one of only 2 or 3 countries in the world that recognizes LIFO. But why would anybody want to be on LIFO for tax purposes? Because it minimizes tax liability if your inventory goes up in value over time. And cars. When's the last time you went on a car lot and you're like, everything is just 30% cheaper than the last time I was on a car lot? No. It's always going up. And so as a result, and we talk about this in 416, we talk about LIFO liquidation in 416 toward the end of the course, which can happen, but if you're in the business like trucks, you're retailing those big tractor trailer rigs or automobiles, grocery stores are on LIFO. Now you think about that. That means the inventory that's on their books is on the books at the cost of the inventory they opened the doors with. So those bananas are way past edible. But it's just an assumption. It doesn't mean you go over there and those aren't fresh new bananas on the floor, right? It's an assumption, and there is no requirement that the assumption method you employ has to match the actual flow of the goods out of the store. Because most businesses would be impossible to determine that. We could, if we're an automobile and we had VIN numbers, or motorcycles and we had numbers, heavy equipment that must have serial numbers or something like that on them. Or if we were in high-end jewelry and I'd say, okay, here's a 15-carat diamond ring, I know exactly what I paid for that. And I know what I sell it to you at X, I know exactly, that's specific identification. But I don't have, there's nowhere in generally accepted accounting principles where they say, this industry has to be on this one. This industry has to be on this one. It's like management can choose. And then management can change if they can get their auditor to agree with them and go along with it. So, for this chapter, you need to focus on those notes. Particularly page 2 of the class syllabus. All right, and then there's a little bit more I want to talk about. This is a 20-point problem on your final. And that's all the information you need. Fill in the box. Each box is worth 10 points. What is EI? Ending inventory, good. Ending inventory is overstated by $20,000 at the end of 17. At the beginning of 17, it was accurate. It's the end of 17 that's a problem. And then at the end of 18, ending inventory is understated by 10,000. And the reported net incomes are 75,000 and 95,000, and we want to get to the corrected net incomes. So let's just deal with the first little part. If ending inventory is overstated, what effect does that have on net income?
It's too high.
Well, you paid more money for your inventory, supposedly, right? So you-
Not paid more, you're
Well,
counting
you have
inventory
bigger
as being here
inventory.
that's not here.
You're saying you have a bigger inventory expense than you actually do. So your reported net income is less than it should be by 20,000. So it should be 95.
So you say net income for 17 should be 95,000.
Yes.
And everybody else is completely silent. Is that
No, I
because
think
you agree with
I think
him?
it's supposed to decrease.
Huh?
I think it should go down by 20,000.
Or you think it's overstated?
Yes. I think the income's overstated.
You think income is overstated?
Mhm.
Okay, we got two people who've taken a stand and they've taken opposite stands. So, do you choose to agree with the gentleman scholar in the back? Or do you choose to agree with almost never right about anything he says guy in the front? All right, you're gonna have to take a vote. I mean, you're gonna have to take a stand here. You're accounting majors.
So you walk it out, right?
You understand financial
Your
statements.
inventory is an asset, but you had to have an expense to buy that inventory. So your expense flows into your net income statement, which if you're over 20,000, then you overstated your expenses on your net income statement, your income statement. And so you took away too much from your overall net income, right? That's what I'm thinking.
Ms. Finch, she's struggling to say something.
So if your ending inventory is overstated, that means that your cost of goods sold was understated, right? So that would mean that.
Wait a minute. She said right? So that was a question on her part.
Yes.
You say, Mr. Carr says you're
I'm
right.
answering.
Your logic is right. Sounds good to him? Anybody else?
I agree.
You agree too? So the gentleman scholar in the back has nobody who agrees with him. Look at this. Do you remember in the inventory chapter, you took beginning inventory plus purchases equals what?
Cost of goods available.
Cost of goods available for sale. And then what did you do?
Subtract ending inventory.
Huh?
Subtract ending inventory.
Subtract ending inventory, and that gave you cost of goods sold. Okay, so now watch this. What kind of account is cost of goods sold? Expense account, okay? So what we've said here in 17 is ending inventory is overstated by 20,000. Well then, Ms. Finch is right. By definition, cost of goods sold is understated by 20,000. And if expense on your income statement is understated by 20,000, then net income is overstated by 20,000. So what is the correct income for 17?
55,000.
55,000. Write this down. I can still remember my first accounting professor saying this. As ending inventory goes, so goes net income. As ending inventory goes, so goes net income. So look at this. Ending inventory is overstated, net income is overstated. They move in the same direction. All right, now listen to me. Listen to this. Let's suppose I own an office supply business. And I have a location in Biloxi. I have a location in Mobile. And I have a location in Pensacola. And I'm an accountant, so I know this. Okay, so my audit firm is out of Montgomery. And they call me and they say, Greg, on Monday we're going to be in Biloxi. And we're going to count your inventory. Then overnight, we're going to drive over to Mobile, have dinner. Bright and early Tuesday morning, we'll be counting inventory in Mobile. And then Tuesday night, we're going to drive over to Pensacola. Bright and early Wednesday morning, we'll count inventory in Pensacola. I say, great. I'll tell my people to be expecting you at each store. They'll know when you're coming. Appreciate you letting me know so you don't disrupt business too much. Okay, thank you very much. And then what do? I take inventory from Pensacola and Mobile and I take it to Biloxi because I want them to count it. And then on Monday night, I take some of that same inventory out of that store over there and I bring it to Mobile because I want them to count it again. And then on Tuesday night, I take that same inventory over to Pensacola because I want them to count it again. Because I want to overstate inventory, which will reduce my cost of goods sold, which makes my net income higher, which makes my banker very, very happy. Plus, he lends me money based on the level of inventory I say I've got. So they counted the same chairs. Can they look at that and say, no, I think I counted that yesterday? No. Because every one of those stupid chairs y'all sitting in look alike. Every one of these tables looks alike. Every office chair, office desk, if it's the same brand and everything else, you can't tell. It doesn't have an identifying number on it that you can say, oh. Now, if I were doing an audit of an automobile dealership, I'm going to do it by VINs, right? So I make sure I don't count the same card 10 times in doing a floor audit. This is why now Auditors can't do this. They can't call you and tell you. They say, we'll be there next week. And maybe they have to descend on all three at the same time. Instead of taking everybody to one, let's take two piece. And if you have to work 2 days, that's fine, but we're gonna be there all at the same time, so there's none of that shenanigans going on. One of the biggest frauds in accounting, this was a business that kept soybeans, corn, wheat, things like that in silos. I'll never forget the time I was on a plane coming back from Birmingham, and I struck up a conversation with a young girl. And I said, what are you coming to Mobile for? I said, you from Mobile? And she said, no, I'm from Birmingham. I'm coming to work in Mobile for the weekend. I said, oh, really? I said, what kind of work do you do? She said, I work with an accounting firm. I said, oh, really? So we talked a little bit about that. I said, what is it you're going to do? I thought, what's she going to do on the weekend? She's going to count cinder blocks, and piles of white sand. She was doing inventory all that herself that weekend. See, you're in a glamorous profession. You're gonna have a great time doing your job. Okay? So, but now, look. So if I'm the auditor on this, and these, there are 50 of these. And some have corn in them, some have wheat, some have soybeans, some have whatever. And I got to figure out some way, because, I can't say that's a gallon. I can't say that's a pound. I got to figure out some way of seeing how much this is, right? So I need to go to math, right? I need to figure out what are the dimensions of this round silo. What's the height? What's the width? I need to do some cubic feet, right? And then I come up with, okay, that thing is slap full. They'll tell me how much, tell me it's full. Maybe I even come up the ladder. There's a little place I can look in, and I come up there and look, and sure enough, it's all the way up there to the top. So it's full. And I do my math, and I say, okay, there's this many bushels of soybeans in here. And the value at market today is this, so that's how much they're worth. Okay, what's the problem with that?
You can fill the bottom with something else.
What they did was they had a false bottom built in every one of these silos. So it only had soybeans up there at the very, very top. Completely empty and hollow. And there's no way for you to know that. But that was to overstate inventory so they could overstate their net income. There's also an example of a guy who was importing vegetable oil into the country. And it came in the hull of a ship. And he had a bank that lent him money based on the value of his inventory. And the banker thought he was being smart. He would go down to the port whenever the stuff would come in, and he would check to make sure that it's got vegetable oil in it. Sure enough, it had vegetable oil. What's the fraud here?
It was the same vegetable oil?
Hmm?
It was the same vegetable oil?
The same vegetable oil?
Maybe they're only putting like the first couple parts of the ship is just vegetable oil, and the other parts are just like empty. It could be empty.
Well, no, this is the hulls, the whole ship.
That's what I'm saying.
Oh, because
Yeah, like
whenever
that.
would it change what the measurements of the weight are if it's underwater like that?
No.
Okay.
Well, I mean, it might, but that's not the issue here. All of that was just water. It was vegetable. Oil and water don't mix. Crooks are really clever people. It was vegetable oil just across the top. And of course, when he would reach in, dip in to get something, it's right there. That's vegetable oil. Okay, good. So he assumed the whole thing was vegetable oil. Nope. Okay, now, so overstating inventory is what you want to do if you want to overstate income. But watch this. As ending inventory goes, so goes net income. But it's just the opposite for beginning inventory. Beginning inventory and net income move in opposite directions. So I'm still waiting for the last box.
I put 85, but I don't know if that's right anymore.
Don't you have to deal with the 17 also though?
Well, I don't know. Let's see. Doesn't the ending inventory at the end of 17 become beginning inventory in 18?
Yes.
So that mistake that we made last year carries over into next year. But it has the opposite effect. This time, it understates net income by 20,000, right? And then we got to deal with our current year mistake. We understate ending inventory, so that understates net income. So net income needs to be increased by 30,000. So it's 125,000. Questions? That makes sense? You can't just take this mistake into account for 17 and then say, now I've forgotten it. Because that mistake at the end of 17 comes right back around and becomes your beginning wrong number for 18. But now that you've overstated inventory for 18, you've understated income for 18. Questions? When you do the Gleim questions from this chapter, and you will be responsible for the Gleim questions, you're going to see inventory errors. And you're going to have to figure out what's happening. Okay? So you got to be able to think it through. So here are the two things you got to remember. As ending inventory goes, so goes net income. That's number one. Number two, beginning inventory and net income move in opposite directions. Beginning inventory and net income move in opposite directions. Okay, so you should be able to figure this out. We're covering 18, 19, 23, and 22. You got 20 to 25 multiple choice questions on your final exam, and you got 3 problems. You're not going to have a problem from 22. So where are you going to have a problem from? 18, 19, and 23.
I thought you just said there's a 20-point problem on the final exam.
No, you don't, you half listen. I said you will not have a problem you will have multiple choice from Lime. I mean, those are fair game. Those are, no, don't just look at the class notes. You also have Lime to do for chapter 22. Okay? 25 multiple choice questions and 3 problems, and a problem will not come from chapter 22. But multiple choice darn sure will. Now, I want you to look up here though. I already erased it, crap. When I had the direct method, you know, people say, well, if you give me this whole thing, it takes me an hour and a half to do a statement of cash flow. That, you won't be able to do anything else on the whole exam. I just have to do the statement of cash flows, that's it. I may give you all that information like the problem does, but remember that problem where it said, okay, given all this information, A, determine cash collected from customers for the year. B, what was cash paid to suppliers for the year? C, what was cash paid for operating expenses? So I could ask you something like that. I could also, if I still had the T account up here for, remember all that information we had about we purchased 98,000 of plant assets? And I would say, I would give you a sentence or two about plant assets. The fact that at the beginning of the year it was 502, we purchased 98,000 during the year, you wind up with 600,000 at the end of the year. And of that 98,000, 28,000 was paid in cash and 70,000 was from issuance of stock. Based on all this information, what will be reflected in the statement of cash flows about this topic? And be specific. What would you say?
The $28,000 in the dividends paid, 28,000 cash for the
Where?
investing.
Okay, you would report 28,000 of cash paid for purchases of plant assets in the investing activity, period. Then you probably should also say the 70,000 non-cash parts should also be disclosed, right? So there's lots of ways. I may not give you an entire statement of cash flows, but I can pick any part of it. For example, I can give you the income statement, and I can give you the balance sheet, and I tell you that dividends of an unknown amount were declared during the year. What should based on this information, what should be reflected in the statement of cash flows? So then you got to figure out the amount, and you got to figure out whether or not it was paid. So there are lots of ways to test you on it. And when you see the multiple choice questions in Glime, if you haven't already, you'll see how they go about it. So I don't have to give you an entire statement of cash flows. I can give you any one part of it or multiple parts of it or little snippets of it and ask that you do it. But if I ask you, but I was going to show you with this one. Let me show you how many points it could be. 3-line heading would be 3 points, 1 point per line. Cash flows from operating activities, that's 1 point, so that's 4. Then cash collected from customers, that would be a point, and the dollar amount would be a point. Cash paid to suppliers. Point. So, I mean, it can get to 35 or 40 points just in operating activities. So this is what I would do. I would say every mistake counts a half a point. So instead of 40 parts, it counts 20 points. So if you miss 10 parts, it's minus 5 points. That makes sense? And then under this method, look at this. This one would be 1, 2, 3. The sign is also a point. When you say cash paid to suppliers, you and I both know that's cash out, that's a negative number. But here, when I say change in inventory, that's 1 point. The dollar amount is a point, and the sign is a point. So let's just say this was a problem. 1, 2, 3, 4, 5. That's given to you, so I'm not gonna give you points for that. 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30. And be cautious of this. I have had people cry on the final exam, and here's why. When they get all the way to the end, they have change in cash during the year, 100,000, plus 20,000 at the beginning of the year, should be cash at the end of the year, 50,000. And they're like, oh my God, I'm $40,000 off. Nothing I've done is right. And what it is instead of subtracting 20,000, you added 20,000. That's a $40,000 error. So it's one little sign. It's one little point, which would be a half a point based on what I said a minute ago. So that's why I try to tell people, people come to me and they're tears in their eyes, and I just can't stand for students to cry. I just can't deal with it. So don't cry. Just rest assured, oh, it's not gonna be that bad, I'm sure. Then if it's really bad when you get your grade, then you can cry, but not in front of me. You can cry at home.
Can't come to you and cry?
Huh?
I can't come to you and cry?
No. No, I can't do it.
Coming to drink.